Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP, accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work-optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Hello, everyone, and welcome to the Millionaire Next Door podcast. Thanks so much for listening. Hope everyone's summer is going well, that you're doing some fun stuff and getting outside and thriving through the chaos and whatnot. But we're certainly doing that on this end. And thanks for tuning in. Today we have an interesting guest I think will be very, very helpful and insightful. We are in a sort of a continuous bull market where the market by and large has gone up and kind of gone up into the right and stayed up there with some pullbacks, but we've been moving ahead. Yet I continually hear a lot of client and people sort of concerns with what about a pullback, a drawdown? What if things change? Am I too aggressive? This is going great, but what about the other side? Or I'm a retiree. How do I protect on the downside? That's obviously a very, very important concern. And sometimes the further we get away from something like that, the less it's on our mind. But it's very, very important to be cognizant of that and have a process for dealing with it. So my guest today is James St. Aubin. He's a CFA and he's the Chief Investment Officer and Portfolio Manager at Ocean Park Asset Management. James, welcome.
Thank you for having me, Robert. It's great to be here.
Yeah, terrific. We had met at a luncheon where you spoke, and I thought it was very helpful stuff I was familiar with, but your process, your adherence to that process. You sent me a wonderful slide deck, Enhancing Portfolio Resilience, the Role of Downside Risk Mitigation and Trend Following Strategies. Do you want to maybe introduce yourself, maybe talk a little bit about you, your origin story, what you do, and then just sort of launch into some of the stuff you'd like to share with us today?
Sure. So, let me tell you about Ocean Park, because I think that helps set the stage for what we're going to talk about today. Because as you mentioned, people are concerned, given how strong the market's been recently, that maybe a pullback is in the cards here this year or maybe soon in the near future. So it's very timely to have this conversation about risk management. And I think, going back to the early days of Ocean Park, our roots date back to the late 1980s when our founders, Dave Wright and Dr. Ken Sleeper, they set out to manage money for individual clients, and they wanted to hang their shingle as an RIA. But before getting started, they wanted to talk to potential clients, investors, about what was most important to them. And what, in terms of their objectives. And there was a very common theme among those conversations, and that was that those clients, most of whom were in or near retirement, were very concerned about losing money and jeopardizing their wealth. So capital preservation or wealth preservation, playing defense, was an objective of theirs that maybe was somewhat underemphasized by a lot of the traditional approaches out there. So they thought, how can we manage risk beyond diversification? So diversification is more what we think of as a passive risk management approach. So they asked the question, how can we be more active in achieving that objective of preserving wealth at a critical phase, right? Because, during the distribution phase, having cash flows in the portfolio, negative cash flows or withdrawals from the portfolio, that can be very detrimental, especially during drawdowns. So they look to provide an active risk management approach to their portfolios. And they started from a white space perspective. And so during their research in investigating different techniques to manage risk, they came up with, I think, two very foundational conclusions. One was making qualitative market calls, trying to pick tops and bottoms, was very difficult if not impossible to do consistently. So they really didn't see an opportunity to read the tea leaves and guess what direction the market might be headed going forward. And the second was that most successful investors that, just think of the big traders out there, had one common trait, which was that they had some form of a trailing stop loss discipline in their portfolios to prevent large drawdowns in the portfolio. So with that in mind, they really focused on studying techniques that would be effective in limiting downside risk, while also, of course, trying to participate in the upside of the market. And eventually they narrowed in on a price trend following rules-based strategy that was effective in limiting some of the exposure to major market drawdowns that, as we know, can be very devastating to portfolio outcomes and also investor psychology. So they really wanted to get to the root of that and understand, of course, understanding the asymmetry between the gains required to recover losses. So if you understand that, think about a 50% decline. Well, 50% gain isn't going to get you back to even. You have to gain 100% to get back to even. So they wanted to think about winning by losing less. It was a way to simplify it. So they weren't trying to pick tops or bottoms, but they were looking for signs that a security or the markets that a particular fund would invest in the direction of the price was likely to perpetuate in one direction or another. So our strategies invest in other underlying mutual funds and ETFs. That we have our own mutual funds, we have our own and ETFs and TAMP models that execute that strategy. And those cross the risk spectrum from all fixed income oriented strategies to all equity oriented strategies, and of course, multi-asset target risk portfolios in between. So that's the essence of our story. We really just wanted to solve a very critical problem for investors, which was to protect their wealth in a very critical time during the investor life cycle.
Yeah, I mean, it's super important. And as someone who's done this for almost 30 years across second and third generation, I hear it from different folks. And then you hear folks too that are overly concerned about losses and maybe missing upside, or other folks who are a little too aggressive or too ebullient, so to speak. But a lot of folks, if they come to us or they're working with us, they're further along in life, maybe closer to retirement or retired. They're not going to earn back that, nest egg that they've spent the last 25 or 30 years accumulating. So, that's on their mind, and they've probably lived through a 2008, through a dot-com, through other pullbacks, and they do want that in place. And so we walk them through that, what that looks like, what it means to get out, what it means to get back in, which can be very challenging too, right? But they want someone who's very mindful that that's the nest egg, and we can't just, if we're driving in winter conditions, we need to be prepared, right, for anything, to slow down, have tire chains,
Right.
whatever, have food,
Absolutely, yeah.
And maybe it'll be just fine, but maybe, you better be prepared. So that's just my little comment and interjection there. But yeah, I agree with everything you're saying. And I'm super mindful of that. I think at the end of the day, you still have to be positive and have an upbeat perspective to even be long in the market. If somebody's so risk averse, just don't go there. But yeah, let me kick it back to you and keep going. Yeah, please.
Sure. Well, I mean, I think you touched on some good points. I mean, you think about what you're, as a financial advisor, you need to, or a client, you need to assess one's ability to assume risk and willingness, right? And so the willingness and ability to assume risks are both two dimensions. Sometimes they're at odds with each other. But the ability to assume risk is usually defined by how close you are to a retirement or distribution phase. And so that is a very much something that needs to be at the forefront of an investor's decision in terms of how much risk to take overall in a portfolio. We know that losses early on in a distribution phase can be much more devastating to the outcome of a portfolio than losses later on in a portfolio's life cycle or in the distribution phase there. So, of course, how do you manage that? Now, everybody talks about diversification. I've never heard anybody say, don't diversify your portfolio. So we all take that as what I would call orthodoxy of portfolio management, that you should be diversified. And we absolutely believe in diversification. But the question is that really the best you can do to manage risk in a portfolio? And this is what Dave and Ken set out to understand when they formed the firm over 35 years ago. And our strategy relies, like I said, on trend following based techniques to have a defined trailing stop discipline under each position. What this does, the purpose this serves, is to prevent further declines in the price of that security, say another fund or ETF, from harming the portfolio. And price trend strategies, there's a lot of academic research behind price trends across asset classes, and it's extensively used by a number of investors. It's also, there's evidence of price trend based strategies going back 200 years. So while we think of ourselves as somewhat early adopters of price trend techniques, it does have quite a bit of history behind it to suggest it does serve the role of helping limit losses, in particular during a period of crisis. Now, we think about the market and we talk about risk sometimes in statistical terms, like standard deviation, which I would say to most clients is a little bit esoteric, maybe not easy to understand. But the standard deviation metric is a statistical term to measure variance of returns. However, the problem is that it assumes a sort of normal distribution of returns, that sort of and that bell curve distribution. But the reality is markets don't behave according to that. And there's a lot, if you go back in history and look at, say, the stock market, for example, there's a lot of evidence, and the bond market, frankly, too, there's a lot of evidence of left tail events occurring. So you think about the 2+ standard deviation outcomes in a particular period, those can be very devastating to investors. And the standard deviation metric would assume those are extremely rare. But in practice, empirically, they happen a lot more frequently than standard deviation would assume. And so we really got to be aware of that to begin with, that the range of outcomes on the downside might be a lot larger. The sort of the fat tail, if you will, it exists. And in order to combat that, that's where price trend following comes in, and having a trailing stop discipline behind a portfolio position can be very beneficial to the outcome.
Yeah, that's really good. I walk clients through a lot of that. It's funny. I'm in Pasadena, California, so we've got everything client-wise from people who are Caltech and Jet Propulsion Lab scientists and engineers to the little, understand standard deviation and the bell curve really well, and the little old lady from Pasadena who doesn't. I try and explain it and make it simpler. I call it zones, as opposed, and I draw a little map of how those work. He brought up a few questions, but we walk clients through that a lot. Where are we within a normal? And sometimes we're in a very abnormal curve, or skewed to the left or the right, kind of that asymptote. And then sometimes it's just a matter of time taking care of that to normalize the curve, But couple of questions I want to, maybe I'll lump together, but how do you avoid, you mentioned something where some of these far tail events are a little more common than you might even think. With the trend following, one question is, how do you avoid sort of whipsaw, coming out and coming in, or sort of sometimes you get a signal way down, but then it reverts really quickly, and you don't want to be in and out and stuff like that, especially with taxable issues and things like that. So I think that's one question. And just to let you continue on, I guess it's July 15th, 2026. So I want to kind of time recognize this, because trends can change, and it will change. Things will change probably by the time this comes out. What are the trends telling you now? What is the lay of the land today as you're looking at it? So kind of the whipsaw question, and then a little bit about the trends.
Whipsaws. Yeah, whipsaws are absolutely, I'd say, a drawback or a risk for all trend following strategies. And you try to mitigate that by defining the time horizon of trend and optimizing the trend signal so you're not caught up in too many whipsaws, meaning that, like you said, where you sell and then the market recovers quickly and you're forced to buy back at a higher price. So that's something, again, that's worked out in the design of the trend following signals. Our buy signals and sell signals are sort of the parameters around those are targeted to minimize the whipsaw risk, but that is inherent, of course, and anybody that's using a trend following strategy should be aware of that. So that is certainly a risk and a trade-off when you're using a trend following strategy. Also, some of the tax implications that should be considered as well in the decision on whether or not to use a trend following based strategy. We obviously, in today's environment, you're looking at the markets in general, have seen very strong uptrends across equities and also credit. So credit spreads have been very stable, and equity markets have been, for the most part, on the rise since, I would say, the bear market bottom in October of 2022. We've had a few hiccups here and there. Think back to Liberation Day being one of the bigger sort of drops in the equity market. And of course, we had a little pullback in March after the war in the Middle East. So those are certainly little, I would say, hiccups, but not the major market destabilizing type of market events that they could have been, right? We just never know when the next shoe will drop. But overall, right now, the market is very focused on some of the very optimistic assumptions tied to alternative artificial intelligence. So that has really propelled the market to these lofty heights and kept credit markets stable and the economy in a pretty good place. Where we haven't seen as strong trending signals is in the duration or interest rate space. So we've had a lot of sort of sideways trading in terms of since I would say the bear market in bonds, right, in 2022. We have been in this kind of sideways pattern. If you just look at a chart of the 10-year, for example, you've seen the market peaked in 2022 and an interest rate in the 10-year of 4.25%. And we've been kind of up and down around that range since that, going back about 4 years now. So we haven't seen this consistent trend that we saw for, several decades back when interest rates were continuously falling, which is a positive for the price movement of bonds. So that's where we've seen less consistency in terms of trends. But right now, we obviously have a pretty strong uptrend in the equity markets overall, particularly, of course, in the U.S. And more lately in emerging markets.
Yeah, it's really, really an interesting time. I mean, you talk about 2022, the bond market, and, people, losing 12, 13, 15%, on supposedly their safe area investment. Talk about a drawdown. So, and just today's, it is this AI space and this drive and this move forward that's just really driving it, even with kind of like consumer trends kind of weak or struggling, the K-shaped economy. It's a really interesting time, I think, for folks to get their heads around. A lot of people don't understand it. I don't know that I do, but I do find following the trends and the data and just breaking it down to simple supply and demand, right? Is there demand for this or supply? The world will tell you. So it is a really fascinating time, and you always need to have processes in place to support the goals and objectives you're trying to achieve, but as much now as ever. Hey, you mentioned credit spreads. For folks who don't really get that, do you want to just kind of tell folks what that means exactly, or how you're viewing that?
Sure. That's simply the premium yield over treasuries you get for investing in corporate credit, for example, the investment
Okay.
grade or high yield, there's an extra spread or premium on top of the treasury yield that you get for assuming the default risk.
Yeah.
Now, let me just actually go back to a point that you were making about the bond market and the experience we had there, because I think it's very relevant to the conversation today about, well, is diversification the best we can do? Now, the 60/40 portfolio, for example, was predicated on this idea that diversification between stocks and bonds was something that you could rely on, right? That bonds would offset stressful market periods in equities. But as we learned in 2022, that's not always the case. We looked at the variation of what we call correlation, which was the statistical measurement of diversification between the Bloomberg Aggregate Bond Index and the S&P 500. And for a long period of time, for about 2 decades, we had a very low negative correlation, strong diversification between stocks and bonds. So we sort of got used to that experience where stocks would diversify bonds. And then 2022 came along, and you had a simultaneous bear market in equities, the 10th largest going back 100 years to be exact, as well as the largest ever bear market in bonds. And the peak to trough was about 18% in bonds. Now, so people assume bonds are going to be a capital preservation tool, not only diversifying equities, but generally stable. Now, neither of those two assumptions held up during that period. So it got people to rethink diversification as something that may help at certain times, but not necessarily all the time. And so, what else can we do about that? How can we manage risk in a portfolio? And an interesting statistic I think people may not be aware of is that the bear market, sort of the peak in the Bloomberg Aggregate Bond Index, was in August of 2020. And the bottom was in 2022, when yields, like I said, rose from a very low level. I think the 10-year bottomed out around 50 basis points and shot up to about 425 in a very short period of time, creating that big drawdown in the bond market. Now, what people may not realize is that the high water mark of the ag has still not been recovered. In other words, the high water mark that we had in August of 2020 on the bond market, we're still underwater there. We're still in a drawdown. So the drawdown, a lot of people think of the sort of the peak to trough decline, but it's really, if you think about the pain investors experience in any asset class, in any investment, it's not really just the peak to trough, it's the peak to recovery. And we still haven't hit that in the bond market, which is pretty remarkable considering that was almost 6 years ago.
Absolutely. Yeah. There's still brackets around those things, parentheses, meaning there's loss of capital. And that's not what we see. That's that worry about loss of, and people seem to sense it or feel it more, or be aware of it more on an equity, but on the bond, they don't seem, but it's the same thing. It's loss of capital, and you have a lot less upside. So if you're losing capital, that's not and less likelihood of recovery. So it's really interesting too. You talk about correlation and the evolution. I remember original modern portfolio theory and diversification, and right, didn't they, some guy win a Nobel Prize, right, in the
Barry Markowitz, 1952, yeah.
Oh, 50. Okay, I was thinking it was in the 70s. So at any rate, I still just see a lot of advisors who hang their hat on that, and they're anchored to that, and it's a factor, but things are evolving. I had to explain to a client yesterday how it's become more nuanced, and the correlations sometimes have broken down, right? Where they might be moving in the same direction, and it's evolved. We've been blending in alternative investments that have lower correlation, or really like infrastructure and things that are really not that tied into public stock or bond markets, but just it's evolved. And I just see a lot of the industry that's hung up on this old, little bit outdated model. It's not to say everything's changed, some of these core tenets, but I think of like someone practicing medicine or something, if they're still doing it the same way they did in the 70s or 80s or 90s or even last decade, you know, these things evolve. We learn stuff. And, and it's the same for us as well within a process. Some stuff remains the same, some core stuff, but some things evolve. Certainly AI coming in, all the trading, through algorithms, it adjusts what's going on. But
Well,
that's just yeah.
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 Well, let me just dive in here because I think you're getting into a really interesting concept that I think a lot of people miss in the conventional wisdom of diversification and building portfolios with modern portfolio theory. So we talk about the efficient frontier. You may have covered this on prior podcasts and how that works and what you're looking for. You're making, of course, assumptions about different asset classes with regard to its expected return, its expected risk in terms of standard deviation or variance, as well as the correlation assumption. And all we know that the return numbers can be very volatile, right? That's essentially an educated guess that sometimes relies on historical data with a forward-looking lens on it as well. But in terms of risk, most practitioners will use historical levels of risk, and we talked about standard deviation and how that may not capture the full range of outcomes that are necessarily possible within a particular asset class or investment. But the correlation assessment or the correlation statistic that gets built into these models is generally viewed as static, right? So you take a long-term history and say, on average, it was X, of course, okay? But we know that is something that can vary quite a bit over time, over the short term. And at times it can be very low and beneficial to a portfolio and help reduce risk, but it can also go the other direction. Now, again, going back to that experience, the first 2 decades of the 2000s, for example, we had episodes of volatility, the dot-com crash, and the global financial crisis, where bonds were the correlation benefit that you got was actually better than the long-term average. However, in this most recent episode, the correlation benefit was a lot less than you would expect. It was actually very positive, meaning you were getting very little diversification. So you have to build real world assumptions, right? The real world experience doesn't necessarily match up to the averages, but that's what you're using in some of these assumptions, and it can be a flawed assumption, knowing that there's a lot of variance or volatility around that assumption, around what happens in practice. And I think Howard Marks says it best when he says, never forget the story about the 6-foot tall man that tried to cross the 5-foot deep river on average, right? So there's obviously a lot of risk in making assumptions about averages that may or may not hold throughout time and during specific episodes and of volatility in particular.
Yeah, it is so interesting. As you're speaking and going through this, we deal with this all the time, right? You're the chief information officer at a RIA. I've been in investment management for close to 30 years. We're wrestling with portfolios all the time. I just thought of something that's really interesting. A couple of things that have come up recently that were just really kind of eye-opening, but they're probably pretty common. For example, one was a prospect who was referred to us, and he's using a lot of AI, but he's probably going to not be a fit and go and do his own thing. But the AI answers that are kicking back to him on these questions about preservation of capital are stuff like, they're really basic still. They're still sort of diversification, sequence of return risks. So this guy's just hearing it for the first time, but he really doesn't understand it in a context of what it's like through a life cycle and how to manage through it. And they're really, really pretty basic. And you got to explain these nuances of these correlations, but the AI is still just. And by the way, I was hearing a pretty interesting discussion that a huge percentage of the AI algorithms and what's just driving some of these answers is just searching Reddit, if you can believe this.
Oh, absolutely, yeah.
Yeah. So, I mean, some things I ask, I'm amazed, and it's a wonderful tool. I just had another really interesting story, or it was to me. Got contacted by a client last week. Really good client. He's the adult son of a very substantial client. So he, terrific guy, always takes my advice, always checks in. He asked me about a particular software stock he was looking at, which I'd heard of, but I wasn't really terribly familiar. So I have a lot of stuff that looks at trends and charts and the relative strength and yada yada. Any rate, not going to mention the name, but it was called a 0 of fiver, so it has the weakest relative strength possible. It's gone from 180 to 90 in a short amount of time. Its relative risk is about a 5 compared to the S&Ps. So all these dynamics are just horrible and would suggest avoid, okay? And I get these questions, which, by the way, for anybody listening, it's a good idea just to check in and get the little, have someone check the chart or what's going on, or, they can still do what they want, but just give them my perspective. So he hears my whole process, and I going through it deliberately to educate him and telling him all these data sets that how I would make a determination that I would avoid this and not jump into this thing, because I feel like there's a major risk of loss of capital. Plus, it's in a totally negative trend. He says, "Oh, hold on. I just want to tell you the reason it just even came up, and I thought about it." And I hear all this, a tip from a friend, Bloomberg, read it in the New York
Mm-hmm.
Times. So he says, well, I just queried ChatGPT and said, what stock is most likely to have the most explosive upside growth going forward? And this is what came up. So
Yep.
that could be the case, but looking at the weight of this evidence as it stands now, which is all we really have, it looked like the probabilities are pretty low. So he didn't do it. He checked in, but it's just interesting. I think there's an awful lot of people querying AI and ChatGPT and Grok and Anthropic and yada yada and trying to. And I don't know if it's there yet. It's not there yet, is what I'm saying. But yeah.
Yeah, look, I think so. Large language models, which is what ChatGPT and Claude are, large language models, rely on information that they gather from various sources, mostly the internet. Like you said, Reddit might be one source, and it gives you an answer, but as far as the confidence in that answer, may be not clear, right? So in that clearly this particular model was looking for a contrarian signal to identify something that might have a lot of upside in it, and that may be right or wrong, but you're really not sure with regard to the model's confidence level in that answer. So I feel like you should be aware of that. There's a famous quote from George Box that said, "All models are wrong, but some are useful." I think that should be in back of everybody's mind with regard to large language models. And you talk about like how they process information and what answers they give. That's kind of a black box. And so people need to really understand that as they explore AI. It's a great tool. And specifically, as we know, coding is a great tool. It's a great tool for coding. But in coding, the rules are very rigid, and there's the sort of effects are never unknown, right? It's very precise in terms of the instructions and what's going to happen when it gives you an answer. That's not the case with markets and investing. There's nuance, and we say there's some art and science to it. Mm-hmm. So I think it's that art part that may get missed in the responses of AI agents or AI tools. So just something for everybody to be cognizant about. We're very excited that it gives very intelligent sounding answers to difficult questions. But again, we just need to acknowledge that doesn't necessarily mean it's right, especially when it comes to a world which has less definition, if you will, than say something like an application like coding.
Yeah, 100%. It might not be right for you. It's not going to understand your biases or risk tolerance or aversion to losing capital or where your head is at. It's not going to know that yet. There's no accountability, by the way, too. There's nobody ever checking, hey, it was wrong. It's just a quick spit out. But I just had to share that as a bit of a public service announcement. And to the person I mentioned who might even be listening to this, I love you. You did exactly the right thing. And I think it's a perfect example of that partnership and that process and how we reached a good decision together. I'm going to start to wind up the podcast in respect to your time and the listeners. And is there anything we didn't cover or any kind of closing points you'd like to share that you think sort of wrap this up, or any other points that you think should be shared in this discussion?
No, I think we covered a lot of ground here, but I just want to emphasize that, as you mentioned at the beginning of the podcast, that the markets are in maybe a little bit of a precarious place given how strong they have been, particularly the equity market, the credit markets, for example. So I would call risk hiding in plain sight today, right? So how are we going to manage that risk? That's what we should be asking ourselves and our advisors. How are we going to manage this risk in our portfolio, particularly if you're near that retirement phase of your life cycle? So I think obviously we have an approach. There are others out there that may be the right fit for a particular situation. There's, as far as our process, for people that want to learn more, our website does go into a lot of detail about our process, about how we define buy signals and sell signals. And we define among those buy signals, which funds are most attractive for our portfolios. So there's a lot of great information on our website about our strategy and also the historical allocations of our strategy. So you can see where we have been most recently and how that's evolved over time. And you can go on our website at oceanparkam.com, Ocean Park, A as an asset, M as in management.com. And that should give you some more information about our strategy in particular.
James, that is absolutely terrific. That's a perfect summation. Folks, you may want to check that out, the site. I love your closing quote, high risk hiding in plain sight. That's something to think about. I'm going to be giving that a little thought as well. I love that. I tell folks I'm thinking, the goal is not to avoid all risk because it's out there or some chaos, but to have an organized process to deal with it when you're in it, because it's going to be there. You can expect it. And so that's what we focus on. But James, thank you so much. Perhaps we could have you back again. I really appreciate the dialogue and the good work that you do and your process and the professional collaboration. And it's great to have you on. So thank you so much. And thanks to folks for listening as well. Appreciate it.
It's been a pleasure, Robert. Yeah, thank you.
All right, everyone. Well, make it a great day. Be good.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors or Royal Alliance Associates Incorporated, member FINRA SIPC. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
All investing involves risk. Past performance does not indicate future results. Specific products discussed are not suitable for all investors.